It's a great pleasure to have with us Tim McElvaine of McElvaine Investment Management. Tim, welcome.
Yeah, thank you.
It's really great to have you with us. Love to learn a bit about your background and how you got started in the business.
First, it's my pleasure to be here, Oliver. You and John have created a really interesting website and publication. I got started in the business. I was first a chartered accountant in Ontario, Canada, and then was working for a bank in Bermuda. And in about 1990, I began to hound Peter Cundill, who at that time was operating out of Vancouver for a job. And I think Peter decided he either had to change his fax machine or hire me, and I think I was cheaper than changing his fax number. So we used faxes in those days. So he hired me, and I started with Peter in 1991.
And when did you start your own firm, and tell us a bit about the motivations behind that?
Well, I worked with Peter. Peter and I had a relationship in one fashion or another for the next probably 15 years. I started my fund in 1996, and I have been investing both in Canada and globally really since 1991, but only in my fund since 1996.
And tell us a bit about, I'm curious, Peter Cundill is one of the investment greats and sadly passed away, and I'm interested to hear from you. What have you learned from him over the years? Perhaps you could share some things that you took from working with Peter.
Yeah, sure. The biggest thing is don't overcomplicate things. Sometimes the most basic analysis is the best. You won't win any models for spreadsheets because if you can't do it simply on a piece of paper, then the calculation's getting too complicated. And kind of linked in with that is have courage of your own convictions. If you really are comfortable with an investment, are comfortable with an idea, don't worry about what other people are saying, or don't worry if you think the next 10% is down, because after you buy it, they always go down, at least in my experience. Just have enough powder to average down and have the courage of your convictions. So there are two things: simple analysis and not simplistic, but simple analysis, and courage of your convictions.
And you apply that globally, is that right? Tell us a bit about that aspect of where do you find the best opportunities? How do you go about generating opportunities?
Well, we like the first thing is we don't really have any market cap constraint. Obviously, North American or Anglo-Saxon markets, as you might typically define them, would be preferred because of familiarity and governance, but you know, the bigger the population you can select from, the better ideas you can have. So I'd like to give you an example. We've had investments for the better part of, certainly since I worked with Peter or since I had my own fund, I've always invested in and out of Japan. Quite different culture, its own peculiarities, but we've always had very good experience there, mostly because we're disciplined about the price we're paying. And I know that's a market where a lot of people have negative comments, but I think it's a good example of, as a book that recently came out on Peter, there's always something to do, and even within a market like that, we're able to find stuff to do.
I guess Japan is, as you say, it's tough to sometimes get over the negativity, and I'm curious, how do you actually go about? Do you do screens? How do you go about selecting or narrowing down the opportunity set?
Well, I guess there's an advantage and a disadvantage to growing older in this business. Certainly having a little bit of gray hair means you have a little bit more of a library of stuff in your mind. The negative is perhaps you're not as fearless as you once were with some stuff. But in Japan, usually we start with a basic type of screen, and then we kind of go from there. Like, for example, the things I found haven't worked as well for me in Japan, or things like buying a whole bunch of cash and therefore paying very much for the assets. I think, especially given perhaps a conflict between the operators of the business and shareholders, that's a model that I haven't found very good in Japan. What I've preferred to buy is something that's a reasonably good business and that's cheap also on an asset value. And that asset value is preferably not cash or cash and securities. Something that is maybe more tangible. Like, to give you some examples, some of the things we've been buying in Japan, I break the Japanese thing into two components. One is stuff with kind of Western corporate governance, and which is probably 2/3 of my Japanese position, maybe a little bit less now. And then the other portion is stuff that I think is just statistically cheap. And under the statistically cheap stuff, what I'm looking for is something that's trading at 1/3 of its high in the last 5 years. So basically down by 2/3 over the last 5 years. And has more than $1 billion market cap. And trades below book. So within that category, we end up with securities like Yamaha Corp, which is, you know, #1 in pianos and very high market share in guitars and drums and etc. Very strong balance sheet, trades below book, 1/3 of its previous price in the last 5 years. We have Mitsubishi Logistics, which is #1 logistics company in Japan. Huge hidden value in real estate, trades at less than 2/3 of where it traded in the last 5 years. So that type of stuff.
And I guess when it comes to these types of situations, a lot of people may say, well, it is cheap, I get that, but how will that gap to intrinsic value close? What do you answer to that?
Well, a wise man today, I think, which was you, Oliver, said sometimes the catalyst is in the price, and that's something that Peter firmly believed, and I firmly believe that if your analysis is reasonably correct and you've paid a good price, especially if the asset value is growing underneath, then you'll be okay. The danger with getting overly fixated on catalysts is, one, it's hard to get a catalyst for free, so you're paying something for that. And secondly, one of the things Peter used to joke about is he'd say at the beginning of every year, there's benign neglect. That security that you've almost given up on will likely be the best performer this year. So everything that you think's going to happen probably won't take place in the time frame you think, and something unexpected will happen, and it'll still work out if your price was cheap enough.
And if we move on to the other basket, the 2/3, can you give us a sense of what you're finding in that?
Yeah, sure. Well, the first thing I'd say is I'm not sure the corporate governance basket will actually outperform the just cheap stuff. So, I'm curious to see how that evolves. The two largest components of that are a company called Monex Group, which is basically you'd think of it as a internet broker, but they do have a very large FX business outside of just the brokerage business, as well as they've recently made an acquisition and have grown a very large US business as well. So within FX, I think certainly they're one of the top 20 in the world, and within basic Japanese brokerage business, they're probably, depends on the month and the rankings, but #3 or #4. It's run by Oki Masamoto, who is a very Western ex-Goldman Japanese. He owns about 8% of the company, so his own money's at work. So that's one example. Another example would be Shinsei Bank, which is the largest shareholder there is Chris Flowers. and we purchased it after the earthquake last year, after they had completed a rights issue. So we're getting basically a discount on a discount. And as I said, the jury's still out on which one will perform better. Certainly having the idea of Western corporate governance makes you superficially feel better, but that doesn't necessarily mean that's where you'll make more money. We'll see. Ask me in 2 years.
We will do. I'm curious also in terms of the this term Western type corporate governance.
Yeah.
What does that really mean? So what does that mean with these companies? Why do you put them in this bucket?
No, it's a good question. Certainly, Western type corporate governance isn't all that's cracked up to be, is it? So, I meant more corporate governance that's familiar to us, meaning shareholders elect a board of directors. The board of directors appoints the CEO, sets the compensation, etc., etc. So I mean that traditional structure, rather than the board of directors really coming from within the organization. So that's really what I meant.
And so, at what valuations are those stocks available?
Well, in the case of Monex, it trades at well below half of book, or about say 0.45 of book, give or take a little bit. Now there's some goodwill on the book because of some acquisitions they made. So and a discount to tangible book is probably about 90% of tangible book. Shinsei Bank has had a huge discount to book, and it in many ways is basically a recovery as they're working through some of the previous problem loans that they had before. But it has a very strong retail franchise, which was what was attractive to me. So retail franchise, working through bad loans, strong. They have a kind of what we would think of as a consumer credit type business, and Western governance. So those factors made it interesting to me. But both of them big discounts of book, both very low price to normalized type earnings. And interestingly enough, if you took Monex's case, last year they repurchased 6% of their shares, so buying back book and doing and paid a dividend as well, so doing stuff that we might recognize.
So there are, unlike maybe conventional wisdom, there are cases in Japan where the management actually does buy back shares, and there are.
Yeah, funny enough, between dividends and share repurchases, Japan actually does a fair amount of that. And one of the things that struck me about Japan, that's a little bit different, certainly different from Canada, and maybe a little bit different from the U.S., is usually when a company says it's going to repurchase shares, it does. Quite often in North America, someone will say they're going to repurchase shares, and then 2 years later they haven't repurchased more than a fraction of what their total authorized repurchase was. But in Japan, Monex, I think at the end of May last year, said it was going to repurchase 6% of its shares. It was completed by the end of June. So it did it.
When it comes to Monex, you mentioned the valuation in terms of tangible book.
No.
Brokerages, why tangible book? Well, aren't there, isn't the business capital light in a way?
Yeah, very much so, and especially Monex. Monex doesn't really have an investment advisory business or an M&A business. It's basically a client business. So their book doesn't have the complications that, say, if you compare it to perhaps Nomura, you don't know what you're getting in Nomura's book because it's has everything from investments to loans to whatever. Monex's book is very, very clean that way. So tangible book, I think, in many ways, if you're buying it below tangible book, you're getting the whole client list, so to speak, their market share, in other words, their name and everything else for free. So that was what was attractive to us. And over their history, especially as volumes pick up in the stock exchange, they've had enormous earning capacity. So that was additionally expensive to us, or additionally interesting to us.
But so the asset side of the balance sheet, are those then client balances there?
Yeah.
And in essence, there's a liability against that, and that's you could even think of those are I guess, ring-fenced assets.
Yeah, well, you know, they would have client assets, and then you obviously have the client liability, and then you have the assets that you've extended the client margin on, and then they've had to deposit with you. So that and then goodwill from their acquisitions, and then their own capital. So that's the main components of Monex's balance sheets. They have a couple of small investments, but they're not significant to the overall balance sheet. But it's well capitalized. It's not particularly complicated, and we've owned it for a couple of years. It's trading at less than we initially purchased it at, but as I said earlier, that seems to be my history. Buy stock, it goes down. You buy some more, it goes down more. You're about ready to give up on it, and then it starts to go up. So,
and I'm curious, so what makes you stay with it? Can you share with us some, how do you train yourself to then still stick with it?
Well, I was dropped on my head as a child, so perhaps I'm not the quickest thinker in the world, so that probably has something to do with it. It's probably a little bit of stubbornness, and also making sure, you know, when I get into an investment, I don't pretend to have done an elaborate research report, but I do put down the rationale, and that's helpful as a stock goes down a third from where you've purchased. Go back and say, all right, this is what I was thinking. Has anything changed? The biggest reason we've found to sell an investment when it's down usually is more that something else has become much more attractive. Now that's a difficult one to do, because the grass always looks greener. So you always want to make sure if you switch, the new thing is much cheaper than what you own. So for the most part, as long as the original rationale has stayed correct, then we'll sit with it.
Just to come back on Monex one more time,
yeah.
So when it comes to the balance sheet, then in terms of the business risks, it's really in the margin lending that is a source of risk.
Yeah, I think they manage that really well. I think the main risk with Monex is that they get squeezed out of the business by the larger players. Now, the flip side to that is that I'm sure they could be sold relatively easily if Oki decided that he couldn't win at this game. But I would say that's probably the biggest risk is the margins just get too compressed and they get squeezed out.
And I guess also with the client funds, they can't really earn anything on them given the low interest rates in Japan. But if interest rates were to move up in Japan, there could be a benefit.
Yeah, they do make some margin for sure. Could it be larger? Yeah, of course. We in 2000 and I guess 2010 now, we bought some of TD Ameritrade, and certainly that was part of it moved up quickly, so we never got a full position and we ended up selling, but that was part of our rationale. There was huge potential for margin to expand in the case of rising interest rate. A little bit less so in Monex. I think Monex is more just volume pickup, retail activity picks up, and that drives their earnings, or it gets taken over at some stage.
And with Shinsei, curious also if you have a view on the larger banks. Have you looked at more of some of the other banks in Japan, and why you think Shinsei is a better opportunity?
Yeah, Shinsei was very specific because they had been really being monitored by the Japanese financial regulator. Chris Flowers had a large position. He participated in doing a rights issue. The stock fell further on the back of the earthquake, and that gave us the opportunity, because I felt, as I said, they had a retail business, they had kind of a consumer lending business that had some difficulties, but it was being worked through, and they had a balance sheet that I figured had been pretty scrubbed down, and they had just raised additional capital. So that gave me some comfort. Just looking at some of the large Japanese banks, I wouldn't have that comfort over the loan loss provisioning to actually invest in them. So that would be unlikely we would do that, even though some of them have traded at a discount to book.
do you think is perhaps the mistake that foreign investors make when they invest in Japan, or what are some of the things you have come across investing in Japan that perhaps surprised you and made you dig deeper into it, or avoid certain parts?
Well, I think probably the initial mistake I made, and perhaps one that other people make as well, is that they assume that the Japanese are doing it wrong and they'll figure it out and they'll do it the North American way, the American way, or you just need to tell them enough times how you think they should do it and they'll do it. And I don't think that approach works in Japan. So if you want to make a corporate governance bet in Japan, you might orient your portfolio a little bit differently than I do. I think I've been a little bit more accepting of, all right, this is what they do, and I'm just going to make sure that's factored into the price I pay. And I said the companies we've been involved with, I've seen very little evidence of self-dealing. I've certainly seen maybe capital decisions that you might not think are optimal, but haven't been necessarily completely bad either. So I think probably that's best. There's a guy in Japan by the name of Scott Callan who runs a fund called Inchigo Group. He a really good guy, and he's been doing a little bit of corporate governance work in Japan, very softly, very Japanese-like, and I think he's had a little bit of success. But that's not my approach. So I've tended to be much more hands-off.
And when you talked about the idea generation, the screens, did you say above $1 billion? What's the rationale for not going into the small cap space in Japan?
Yeah, well, for Monex's market cap's below $1 billion, but that was a very specific situation. For the statistical stuff, I just like I've had some success with small cap Japan, but if I'm just kind of buying it by the numbers from Victoria, I want it to have a little bit large enough that I'm not dealing so much with personality of the operator, more dealing with an institution, because that's a bit more predictable. If I was going to go and spend a year or two in Japan, then certainly I'd want to look underneath the surface at the smaller stuff. But to be quite honest, when I can buy Yamaha at a discount to book, or Mitsubishi Logistic at a big discount to NAV, you're not giving up anything you're not paying more because they're more liquid. And I'm quite happy. I think Yamaha's market cap is $1.8 billion, I think, US, which might be small for a lot of other investors of yours out there, but I'm not that rich, so it's a great size for me.
I'm curious, how do you slot perhaps Sony? Now it trades in sort of low teens in US dollars on the US listing. Presumably corporate governance is, how do you view that? It statistically looks very, very cheap. What do you make of Sony?
Well, it's interesting. I owned Sony briefly, but at one level you'd say, well, it has kind of Western corporate governance in some ways, maybe a little bit less so today. But they kind of following maybe what Charlie Munger said, I kind of look at the piles on my desk, and I have kind of things that I think I can understand to get my mind around, and things that there are too many issues and I think they're just a little bit too tough. And Sony, I quickly put into that too many issues and too tough basket. There's too much going on, there are too many moving pieces, and there's other stuff that's simpler to do. So that's why I left Sony. But I see it came down again over the last couple of weeks. But so it's tempting from a kind of value type basis. But having looked at it, there's easier stuff there's that for me to do.
And perhaps some people won't know this about Sony, but Sony does own quite a large financial services business, large relative to its recent market value, which is listed separately. Have you looked at that?
Yes. Well, it's primarily a life business. It's relatively expensive as far as some of the other life businesses go in Japan. And that's a business which I'm a little bit uncertain about what to think, especially if you get rising rates in Japan. So it falls under that category of assets that you think they could dispose of, and which reduces kind of what you're paying for the Sony business. But I didn't have enough confidence that, one, it was actually worth a lot, certainly a lot more than where it's trading. Two, that it was actually something I wanted to own. And three, that they're actually going to separate it. Now, maybe I'll be wrong on all three of those, which won't be the first time, and that's part of investing.
What advice do you have to people who are, I guess, maybe frustrated with some of the company-specific valuations and getting comfortable with businesses, and where the macro starts entering the picture? As a value investor, how do you deal with that? Have you changed anything over the last 3-4 years?
Well, it was simpler when I started, because simpler in some ways, because there was a lot less noise, and I think probably one of the things that's very complicating is the amount of macro stuff that you get sent. So there's not only the expectation by perhaps clients, the expectation perhaps by yourself, and to have kind of a view and to pay attention to what's happening on the macro stuff. But as a value guy, I found that if I get stocks, if I pay a good price for stocks and they have this duration, meaning they're not going to go under, they're not going to have the per share value dissipated by management, that things work out okay in the end, regardless of the macro environment. So I remember I had the fortunate, John Templeton was an investor in Cundill's, in a couple of Cundill's funds, so we had the opportunity to meet him a number of times, and he told a story, as I'm sure has been retold tons of times, that one of the reasons he moved to Bahamas was so he could get the Wall Street Journal a day later. And maybe that's something everyone, including myself, should think about a little bit more next time you turn on your boat machine or CNBC.
And also, I guess one of the sayings was trouble is opportunity, and there's certainly a lot of trouble in the world, as has always been, and one way to look at it, I guess, is there is that much opportunity as well.
Yeah, certainly the amount of volatility has scared people, and I understand that. If I was a 75-year-old trying to figure out how to earn income on my life savings, this environment is very unsettling. So I have, a lot of sympathy for that. So turmoil means volatility, which is right, which is if your time frame is more than, say, a couple years, it can be a very good environment for you. So.
And in terms of purchasing power preservation and growth, how do you think about that?
Well, first of all, I'm not a big fan of gold, primarily because the demand supply is so out of whack. I owned silver in the past when demand supply was the other way around, but gold, there's so much supply that comes from recycling and mine growth that the real demand for gold is driven completely by investment demand. It's not driven by industrial demand. And when something's driven by investment demand, certainly my whole life is being spent trying to avoid those areas, because investment demand can become investment supply. So notwithstanding the views of people much more intelligent than I am on gold. It's not an area I've felt particularly comfortable with. Like others, you wonder a little bit with how the current situation resolves itself. But keeps coming back to what we discussed earlier. If you feel you've bought a stock whose asset value will increase even moderately over the number of years, and you've got it at a sufficient discount, then that's what I'm going to feel most comfortable with.
That could be, or is primarily businesses, equities.
Yeah, businesses. Yeah.
Real estate.
Well, sometimes once again, everything has a price, right? So we've owned timberlands, we've owned real estate investment trusts. We don't own any right at the moment, and I'm not sure how inclined I would be, but we own things like Howard Hughes, which has a significant land bank. We own some shares of a company called Avatar in Florida, which has a significant land bank. So yeah, I much prefer to own something like that than gold or something, or certainly a 10-year treasury, which seems a little bit ludicrous, but I hope it works out well for everyone.
Some investors have also moved into commodities, and you talked about you don't like the resource sector in Canada. Why?
Well, like as I said, I'm a turmoil buyer. So when things, we got involved with some oil stuff, and we had a big position in Teck, which was primarily a copper company. But this was in 2000, 2001, 2002. So if there's some more turmoil and the valuations get cheaper, I'd go and take a look. We took a little bit of a look at the uranium area after the earthquake in Tokyo, but prices didn't get quite to what I was comfortable with. Oil and gas, I don't know. The problem is a lot of the cash flow goes back into buying the businesses. They're not true liquidating trusts, so to speak. It's reinvested, and you're taking a reinvestment risk, therefore, not only on the success but also the price that you're going to get in the future. So if it was really cheap, I'd look at it, but we're not doing anything right now. Took a look at some gas things, but I couldn't find the exact way to play that, so keeping an eye on natural gas, but don't own anything right at the moment.
You worked with Peter for more than 10 years, and you mentioned the book that's come out on There's Always Something to Do.
Yeah.
Does it represent well? How do you recommend it?
Yeah, it's a good book. I think you can get it on Amazon or your local bookstores. There's Always Something to Do by Christopher Riso-Gill. It's a great book. Peter had a lot of personality, so I don't know if it pulls as much personality as and that's nothing negative to Christopher, because I think it was meant to be a serious book, but Peter was a fun guy to be around, and it gets back to what I said before. The book talks periodically about kind of overviews that Peter had, but the Peter I worked with was very good at thinking about people's emotions, people's incentives, and having conviction of his ideas. So I think he would have enjoyed this environment, and as I said before, I'm sure he would have enjoyed Italy.
Well, on that note, thank you so much for your time.
It's been my pleasure, Oliver. Thank you.